Hello, accounting superstars. This is Professor Don Bush. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting, so welcome aboard here. You came to the right place. So this lesson is designed for people who are in about their third, fourth week of accounting class and starting to learn adjusting entries. And adjusting entries are difficult. They're not easy. Everybody struggles with them. But if you take them one at a time, they're not too bad, and with time you'll get the hang of it. So what we have going, we've got when we get to construction and they have a loan out. They've got a loan for $5,000 and an annual interest rate of 6.2%. And the time, we've got 90 days of interest that has accrued. All right, so interest has been building up and it's been accruing, and we've got to figure out, well, how much interest has accrued? Well, the trick is, since this is based on days, you have to ask yourself how many days are there in a year. There are 365 days a year, and so all we're going to do is take 90 days, divide it by 365 days, and that'll get our time on an annualized basis. So here we go, let's calculate that interest. Here we are. So here's the formula. Right here. I equals PRT. I party. All right, easy way to remember it. P stands for principal, which is the $5,000. R stands for the rate, and we have a 6.2% annual rate, and the time is 90 days. And again, we have to get this on an annualized basis, so we need to go 90 divided by 365, because there's 365 days in a year. So here's the calculation right here. Here you go. So the interest is going to be $5,000 principal, that's the P, times 6.2% interest, which is the R, and 90 over 365 will be the number of days or the time. There we go. And the interest comes to $76.44. So at this time, the accountant would do a journal entry, an adjusting entry at the end of the year. So this is to show in the books that interest has accrued, interest is owed, and it's not being paid, but it's owed. All right, so we've got interest expense of $76.44, interest payable of $76.44, and that's the journal entry. Now, a good way to remember this is expenses usually go first. 99 times out of 100, or probably 999 times out of 1,000, interest expense goes first. And I'll show you examples where that may not be the case, but not today. So interest expense, $76.44, list that first. Interest payable, that means we owe the interest. This is a liability. So let's go down here and let's look at this little worksheet. And the reason why I'm doing this worksheet is to help you visualize what is going on. And years ago, accountants used to do these worksheets, but not so much anymore. So interest expense here, well, it turns out that on the books right now, not including that $76.44, we've got $300 of interest expense. So what we're going to do, we're going to take this debit up here, interest expense for $76.44. Let's put it in the adjustments because this is an adjusting entry, and let's get it to our adjusted trial balance. So here's what we do. We go debit $300 plus another debit $76.44, and we end up with a larger debit balance of $376.44. So in other words, if you take a debit, add another debit, you get a bigger debit, right? It's easy. Now, where does it go from here? Does it go to the income statement or the balance sheet? Well, you have to remember there's only two things that go on the income statement at this point in time. Revenues and expenses, that is it, nothing else. Now, interest expense, it's an expense. It goes on the income statement. So you might ask, well, does it go as a debit or a credit? How do I know? Well, all you do is you just see that it's a debit on your trial balance, so you just move that over to your income statement. And you might be saying, well, don't debits and credits have to balance? And the answer is, yes, they do. They do have to balance, but you're only seeing just a little tiny bit of this worksheet. It all does balance. Coming down to interest payable. Well, folks, right now on the books, we've got $25 of interest payable, and it does not include that 7644, that adjustment. So let's put this 7644 in the adjustments column as a credit. How did I know it's a credit? Well, it's a credit up here in the adjusting entry. So here's what we're going to do. Let's take this $25 credit, add another 7644 credit. We're going to have an even bigger credit. In other words, you take a credit, add a credit, you're going to get a bigger credit. There you go. All right, now where does it go? Income statement or balance sheet? What goes on the income statement, folks? Two things: revenues and expenses. Interest payable is neither one of those. All right, interest payable is a liability. So what goes on the balance sheet? Assets, liabilities, and equity. That's what goes on the balance sheet. So we're going to send this interest payable to the balance sheet. And you might be saying, well, does it go as a debit or credit? What's going on? Well, all you do is you look at your adjusted trial balance. It's sitting here as a credit for 101.44. So you send that over to the balance sheet. Here you go, 101.44. And you might say, well, gosh, my debits and credits don't seem to balance here. And that's okay. They don't have to balance. You're just seeing a little portion of this worksheet. And the reason, again, why I'm showing this to you is to help you visualize what these adjusting entries are doing and where's the information going. So I hope that helped you out here, folks. So the key to the lesson here is when you're calculating interest, if it's the number of days that you're trying to use, you have to divide it by the number of days in a year. So like 90 days divided by 365. If you're doing this on a monthly basis, you would divide it by 12 months. All right, here we're dividing it by 365 days. So I hope this helped. And if you like this video, if it helped you out, hit that subscribe button, hit the like button. That'll help the YouTube algorithm to make these YouTube videos show up more. And that way more people can watch these videos. And you'll get to see more videos too. So until next time, over and out.